Yeah, hello Arseny. As far as I know, you work as a CFO of a startup company. So could you please tell us a bit more, maybe about your own experience?
Hello, Ilya. I've been working for this startup company for half a year. Before that, I worked for the large banks like Moscow Credit Bank, Открытие, Central Bank, and these are the institutions where I got my major experience. So my experience is mostly connected with the corporate financing, with the private debt, private equity deals, something like that, yeah.
Okay, yeah, thank you. And as far as you know, the main topic of our course is financial modeling. And did you have much experience with financial modeling?
I did a lot of models for the investments that we made in the Moscow Credit Bank, in the Открытие, and even now as a CFO, I do, because it's a small startup, I do them with my own hands, and it's quite a handy instrument.
Mm-hmm. And do you think that models still play a big role?
They play essential role when we're talking about the forecasting for the reasons mostly connected with the investors, with the CEO. Basically, it's the only instrument when you can calculate the corporate case, because otherwise you will not be able to quantify it and protect it, the case with your supervising officers and something like that.
Mm-hmm. Okay. And what do you think is the most important when building a model? What factors and I don't know.
I think that the financial model should be simple. It should be outlaid nicely, because the person who will give you a hand or challenge it, this person should be able to understand your model and all the logic that and all the inputs in the fast manner, and otherwise he will not understand it, and it will give a lot of complications and misunderstanding.
And about different industries, is financial modeling also different for different industries, or maybe it's pretty the same?
I believe that the financial models, they are different because the new industries, they introduce new ways of monetizing. Also, the financial models, they tend to differ in terms of the details. They have to implement, because like when you're trying to forecast a small company, you can use a simplified approach. If you do something complex and the deal value is around a couple of billions of dollars, I think that your supervising officers, they will require more detailed approaches, and they will require all you can give to it, all the details. So in simple terms, yes, they are different, and they tend to be different.
Okay, yeah, thank you for your answer. And the last question, and what would you recommend maybe for those people who just start getting acquainted with financial modeling?
I believe that financial modeling is a skill, and obviously you have to try a lot, to fail a lot. Obviously you have to get as many templates as you can get from your colleagues, from your friends, and networking is very essential in terms of to get this actually, and you should be able to see as many models as you can get, so you can properly understand them, just to find the template that fits your mindset and to fit the business model of the company.
Okay, thank you, Arseny, for coming.
Yeah, thank you. for having me here. Bye. Hello, my name is Arseniy Ronov. Today I'm gonna show you the financial model of the educational technology company that is located in Russia. A small disclaimer that I have modulated all the values and digits, so I will not violate the confidentiality agreements. So particularly this company, it sells the educational courses to the end users that are people, right? So it's B2C company, business to customer model. It's very important to understand that there are two types of the modeling the revenue, right? Is when you're going up to bottom or bottom up. Here we go with the up to bottom. It means that we modulate the market first, and then we go down to the company's revenue and the company's abilities to work, actually to generate the revenue. So here, as on my screen, you will be able to see what I've just said. We start with the population. This is the actual population of Russia. Forecasted population of Russia, just some rough forecast with a nice layout, so you will be able to see what we do here, right? So then we move to the total addressable market. This metric you will be able to see many times in the IT industry. It's called TAM, SAM, SOM. So it's total addressable market, serviceable available market, and serviceable and obtainable market. Meaning that when we're talking about TAM, we're talking about the target audience and how many people actually can consume the products, right? Just in theory, right? Then we go to the business model of the particular company. So we move to the service available market. It's the thing that will be able to show you that. In the very bottom, we have to understand and estimate how many people actually learning online. So how we do that? We estimate the target audience. It's roughly about 50%, right? So meaning that 50 million of people are able to learn, and actually they have the urge to learn, right? Then we estimate from the market research, we estimate the penetration of the online learning. It's 8.5%. So meaning that only 4.3 million of Russians are actually learning something online. Then we estimate the structure. You will be able to find this in the market research also. Just Google it. So we can see that the major categories of the people learning is like preschool, school, professional education, high school, and additional professional education. So you will be able actually to find to calculate the answer for the question how many people are there in the particular segment, right? Then we move to we're trying to answer the question how many of those people the company is able to service. So as you can see here that the company has the market share around 15% in the segment of additional professional education. So here it's like 33,000 people, or the product itself, it's able to sell in 2021, and around 93,000 people in general, right? Including all the other segments. So this is the pivotal thing, because when you understand how much units the company sells per year, you can easily calculate the revenue, right? If you know the historical average of values, what's the average revenue per user in the particular segment? Here we got the values something like school 45,000 rubles, professional education 65, high school 180, additional professional education like 75,000 rubles, right? We add gross to that, yeah, and then we actually calculating the revenue. It's around here, it's like 6.7 billion rubles in 2021, right? It's very essential that you understand the ARPU, average revenue per user, and the concept of lifetime value. These concepts very close to each other, but slightly used differently and mean quite different things. LTV is commonly used in IT industry because it's able to show how much money the client is able to produce for the company within all the life cycle of the company. And LTV can be calculated within 3, 5, or 6, or 10 years. So ARPU, basically, it's the average revenue per transaction. For example, it can be used anywhere. For example, in the shop or something, when you got this metric in the restaurant, right? Average revenue per user, it's also called the check, right? The bill, the average bill. And normally LTV covers more is lengthier, it's bigger than the ARPU, but in the particular company, LTV equals ARPU. Because they normally, after that particular course, a person doesn't come back. This is the business model of this company and or the kind of companies that I know. So, after we calculated the revenue, we can go to the costs. In order to estimate the costs efficiently, you have to understand the drivers for each one. For example, in personnel, the main driver is the sales or revenue per one employee. Here we estimated it's like 8 million rubles for one employee. So if you just divide the revenue for the period, you'll be able to understand how much what the headcount you need in order to calculate the costs. So here we estimated that the company is required 844 people. So you just multiply it with the value of the average salary, and you will be able to find the personnel costs for the period. In the marketing costs, for example, we have a bit different technique. We just calculate it as a fraction to sales. So here it's 35%. Just in case in Russia it's a market value. I mean 30-35. It's a good customer acquisition costs ratio to the sales, right, or to LTV, that allow the company to move forward and to get more clients. In the partners costs or fees, right, we just estimate it as the fraction to sales also. Service costs, it's also the fraction of sales. And the content creation, it's a bit different. Here we basically it's the most essential for this particular business model, because without the content, you cannot produce the sales because you have nothing to sell, right? So here we estimated that average cost of product creation is 1 million rubles. The next question is, how much courses do we need? How much products do we need per year? We estimated that normally products to course ratio is 200. So just dividing the product sales in units by this ratio, you'll be able to get the value of how many products do you need to create per year, right? So after that, you'll be able to understand how much money do you need for the content, right? So here it's like half a billion rubles per year. Selling and general administrative expenses is the most difficult thing to forecast. So normally people just take the historical value and they multiply it by 6.6% or something, or as a fraction to the shares normally. And here you'll be able to forecast it, so it doesn't have any particular driver. So after you have plotted everything in your assumptions sheet, you'll be able to actually make a profit and loss statement of the costs I've mentioned before. So here we estimated like 32% of the EBITDA margin. Just a simply profit and loss statement that you'll be able to see it everywhere. You can see that amortization is also required too, so we do the basic things like forecasting of the amortization. You just need the amortization rate, right? The capex. Capex is a bit uses simplified approach also. It's just multiplied by 5% per annum. You do the simplified the working capital. It's not essential because the IT companies, they normally do not require actually the working capital because they asset light companies. You do the modeling of the balance sheet, cash flow, and the valuation that actually has nothing special in it. You just calculate. Here we use the free cash flow method, free cash flow to the firm. So we estimated the discount rate as 20%. Normally, investment bankers, they use their gut feeling for this input because on the emerging markets, normally the capital asset pricing model, it doesn't work. You can do a lot of research, but still you might not be able to reach the value that offer your shareholder the right perception. Normally, investors have their own perception of the weighted average cost of capital, so you just actually can apply value that you've seen before in some kind of relative projects or something like that, and you calculate the enterprise value. So as simple as that. To wrap up, I believe that financial modeling is a very important tool that for the investors or for the CEO to understand your drivers, to understand your the points of the value creation very thoroughly and give a proper attention to that. And I believe that 90% of the financial model is hidden in its outlay and simplicity, because normally the guy who makes the financial model, he doesn't make it for himself. Everyone should be able to grab a coffee and to look through it and to make it in a fair and efficient way. If it's messy or if it's very complex, it uses complex formulas, it will take a lot of time, and normally people just try, if they see something heavy or messy, they do not look through it, they do not understand it, and it results in a misunderstanding, and in mistakes. So keep it simple, keep it tidy, keep it neat, and keep it well assumed. Thank you for your attention. Have a nice day.
Hello, everybody. Artem, thank you for coming today. So, as far as you know, the topic of our course is financial modeling. Could you please tell us a bit your experience and how it's about your experience with financial modeling?
Hello, Ilya. I'm pleased to come today to you. And I have graduated from Financial University under Government of Russian Federation with master's degree in 2017. Then I have worked in English-Lithuanian investment fund where I have got a deep knowledge about bulk commodities market, and I have some experience that have changed my vision about career and working in equity research. I understood that it's pleasing and very enjoyable task for me, and I can grow endlessly here. After this, I have worked in Freedom Finance and then in Elgalon Capital, and now I'm working in Barbacane Research. And I feel that for me, equity research is something, not a work, but a vocation. So it's what you do with love, and you can do it all the time.
Okay, sounds interesting. And what industries did you cover and cover at the moment, for instance?
So my primary industry was mining sector and bulk commodities of iron ore, thermal coal, and metallurgical coal. Now I'm covering semiconductor sector, renewables, big cap, mobility, and fintech.
Okay, and from your own experience, do you think that models are different for different industries?
Wow, in equity research, sometimes it's different, sometimes not, because the first thing that you're getting, that it always depends on what management present. So if management present great amount of details, you can model differently. If it doesn't differ, it's revenue structure, cost structure. No, model is very similar. And also the great difference that financial models are identical, while operational models differ between them.
Mm-hmm. Okay, and what if we try to compare private equity models and equity research models? Are they all different?
I have seen some private equity models and they are very different. So you have to work with greater assumptions and you have no normal. And because companies just started doing their business, running their business, and it's always very complicated thing. Where on public market, you always have the growth rate of the industry, growth rate of the economy, and maybe the growth rate that is presented by the management and evaluated by the other analysts. So there's always some kind of norm that you have to take into consideration.
Mm-hmm. Okay, so we have come to the question related to assumptions, and where do you get those data usually?
Well, primarily, we're getting from Googling it. Yes. So in equity research, you really have to Google much and with great accuracy and emphasis on the details, what you are getting and how you use it. So you have to apply the common sense as well as to other research and evaluate, does this analyst made a good work or it doesn't make sense and you have to just garbage it into the can. Also, many assumptions we are getting from the public statements, investor day presentations, and from researchers of bulge bracket banks and well-known agencies. So there's great variety of sources where you can find some things that you are interested in, and it's what you are getting when you are coming to the equity research as an industry.
Okay, if we just look at your whole experience of financial modeling, how many models did you have a chance to make within your career?
As my career has started only in 2018, that I have built around 300, maybe 400 financial models for a great variety of companies. I have started from big cap and mining sector, and now I'm modeling just what I love and what I seek as an interesting investment opportunity. And it's just you are getting that it's always simple, and you have to make some assumptions to get to the target price.
And could you maybe tell us a bit about like the best models that you have built, maybe the best examples?
Yeah, well, I have around 4 great examples that I have built throughout my years, and it's something interesting because the first model that I have totally succeeded, it's for Enphase Energy that you are getting in your course from me. And another model, it's Norfolk Southern. Norfolk Southern, it's an American rail company, and it works just like our RGD, making railroad transportation around the country. And both models worked nicely in 2019 because I have made on Enphase Energy around 250% of return in 3 months, and Norfolk Southern have returned in 4 months around 30%. And I have built 2 models with strict target prices. I have defended them in the investment pitch with my senior, and it worked nicely. So financial models work.
So it sounds like financial modeling could be really profitable if you know how to deal with them.
Yes. I would say that financial modeling still works very strictly, you just don't know the speed. So every time your model will work and forecast something, if you apply proper common sense, yes, it will work for you and return money to you, but you don't know how fast. Maybe a year, maybe 5 years, maybe half a year.
Okay, and Artem, what would you recommend for people who just start their career in equity research, for instance?
It's a great difference here between who start a career and already a junior analyst and who is a student and only means to go into equity research. For students, I would recommend that you have to try and to build many models from the companies you like and you are interested in. Or maybe you believe that future is built by these companies. So you have just to get into the net, investor relations of desired company and build model one after another, and you build your skill very fast. If you are already a junior analyst, you have to work like an IB, investment banking, for 100, maybe 150 hours per week. And it's nice because in investment banking, you're having greater deadlines and you have to make something really fast. While here, you are not in a hurry, but you have great freedom to build as much models, build as much analysis as you like. And it's only up to you if your 1 year in equity research costs 3 years, 5 years, 15 years. Just you have to make what you like, and up to you.
Okay, yeah, thank you, Artem, for coming today. We hope that the students are going to enjoy our talk. Yeah, thanks.
It's joy for me. Thank you. Hello, dear students. Today we'll speak about financial modeling of public companies. It is used widely in the industry in Russia and abroad. You will be able to check some techniques in the model that you have after this course. So, the main difference between public and private companies that we have to show that model to wide audience. Also, you can build this model from your home and without any troubles, because all the statements are in the net and you can download them and make the same. So, first of all, in the financial model of public company, you have to use legend in order to other people to know how to read the model. And it provides flexibility and it's easier to understand for people who don't work head to head with you, shoulder to shoulder. Also, on the second page, you have dashboard. That's the core metrics that you track in the valuation of the company, and it's also could be printed to make a presentation out of this in case you have investment committee or something other. So here you can see the basic data, valuation metrics, multiples, then football field chart. It's a basic technique widely used in Goldman Sachs, Citigroup, and so on. Also, price sensitivity is important metric because it shows what affects your company and its valuation. The same you can build in private company, but in public market you have greater data and you can check does it really affect the stock price or it doesn't. And also the last, that actual and forecasted financial reports, they reflect what you have built in the model and how it forecasted into the future. In the quant page, you can see that every valuation should be cleared from some metrics that makes no sense. The basic of the financial valuation, it's the building of common sense into your model. Everybody can build a model with some knowledge, but applying proper sense improves your model to a greater extent, and it's what people value in your work. So there you can see some techniques that I have used. Z-score, it's a widely used mathematical metric to find and exclude outliers. And you just have to make some rules how to exclude and how to maintain them in the model. The basic page of the financial model, you can see that should be made simple and also built one after another. So what you can see here: three statements, income statement, balance sheet, and cash flow. Then you build some basic data that are calculated from these ratios. It's multiples, solvency ratios about the debt structure and liquidity that could be tracked by your investor or by your senior colleagues. Then you build intrinsic value of share. Here we evaluate operational model of the company, because every company could be valued not only based on assets, but based on their operational metrics. What it means? You have a fixed number of shares and you divide different layers of revenues, operational margin, gross income, on this number of shares. And when you sum them for the year, you are getting what company earns with its operation basing on one share. And you get here the share price. This metric is created from the approach of Warren Buffett, and I like it very much. Also, then we have to build margins, growth rates, and so on. And here we forecast them. Important notice here that we have to forecast in most cases flat forward. What does it mean, flat forward? Okay, let's make an example that you have covered renewable energy for 5 years and you know everything about how to build solar panels, wind turbines, and so on. And then you are getting a company from semiconductor industry. And here comes problems, because you don't know these companies. And you have only to create your assumptions based on what have said management or other analysts, because you haven't run semiconductor company in your life previously. And you can't make assumptions on bold predictions of your maybe not such big experience as others have. So flat forward always works nicely, and you are getting some kind of consensus that may be used for end-up valuation, and that could be discussed with other colleagues, seniors, and anybody. So then we calculate PP&A, CapEx, D&A, net working capital, all other metrics, and some supportments. Also, basing on financial statements of different public companies, you have to build maybe big, maybe small operational models and some supporting charts that could be used for your presentations, for your pitch of the company, of the stock, and so on. So it's always useful to add to the model and to show how you look at the company and what you evaluate when you build your financial model and investment idea. So here the company is quite simple despite its big size because it doesn't report some very great variety of operational metrics. And so here's operational model is quite simple. If you try to build the model of ExxonMobil, for example, and it reports very, very detailed report about their operations, about of their revenue, and so on, you'll have to make greater emphasis on what you forecast, how you forecast, and where the costs come from. So there we just build what company does and how it reflected in the share price. Then we go to the peer analysis. Quite interesting always, because here you evaluate your company in comparison with competitors. So you have to know the sector, or you have to Google very, very much about who are the competitors of your company. You have to take their financial reports, take some core metrics that are used to evaluate their multiples, and you're going to compare one to another. Also, some people like to make greater emphasis on debt load, maybe on margin level, and so on. So it always could be added, but the core is multiples on the public market, because every time you have to sit next to your investor and to say why maybe PE of 188 is reasonable evaluation of this stock at this time. It's always have to make a great reasoning and to have answers to very strange questions. Yes, it's always people's business. So you have to communicate your ideas and your vision with great and reasonable answers. So after this, we are going to the well-known DCF. In public market, it's always greater to have greater amount of data, no matter how it sounds. So why it's so? Because we don't know how and what comparison other analysts evaluate your company. So some may be using free cash flow to firm, some may be using free cash flow to equity. You have to collect greater amount of data. And here we're using 4 DCFs at once in order to get our next evaluation of the company. So in the financial model, actually, we have checked that we can evaluate our assets and operations. And it reflects our past company's value that it's already has built. Then we compare a company to its competitors and how good or bad it has built its operations and business, and does it evaluate it in accordance by the market and by the investors. And in DCF, we are evaluating the future of our company. Also, we can build, of course, some industry model where we model not one company, but whole sector, and understand what's forward multiple of the sector and so on, but it's greater and more complicated analysis. Here in DCF, we have to show that we calculate and how we calculate 2 different DCFs and how we use end-up valuation with terminal growth rate and terminal multiple. They both works quite nicely, and there you also make assumptions. Some could be based on what you have built in the model previously, some have to be hard-coded, and it's your assumption. How, for example, here I got terminal growth rate of 2.5% and 3%. It's a basic rule that terminal growth rate of the free cash flow to equity should be higher than free cash flow to firm, because equities always demand greater return than what you are getting for debt investors. And we have to assume here that it's important for us to get a FCF greater than inflation, target inflation of the Federal Reserve System. It's around 2% still, despite its greater on current scale. But we have to make an assumption that our company will grow faster. Why it will grow faster? Because this company works in solar industry. It's greater innovative business, and it has around 15, 20, maybe 30 years of fast growth rate. So on last pages we can see that cost of capital should be calculated in separation with all others metrics, because it's complicated and it takes many parameters in order to build it. And these parameters we take from different pages of our model. Then we also add to valuation historical prices of our company, because no matter how you evaluate your business, price of the market and sentiment of the investors influence what your company costs. So there's always a sentiment, and we take annual share price, taking average, median, and mode. Also, other pages reflect what you are getting from external sources. So Damodaran have all betas, equity risks premium, regional equity risk premium. No matter how you good at what equity risk premium in Albania and so on, you are better to take just Damodaran tables and make a very conservative predictions. Also, you have to collect risk-free data about what are the risk-free rate in different countries. Here, it's all comes to what you can do in your model, and the core thing, how you build your assumptions. I would advise you to build them flat forward, because you don't know the future, and it's better to assume that it's going to be concern like this for 5 years, and it's quite okay prediction for the industry. Here we'll stop, as I have covered most of the questions, and you can try everything in the model by yourself. Thank you.
Now we're gonna consider a model in real estate. I think that maybe real estate is the most simple way how you can forecast any company's activities. So if you have a model from real estate, it can be done much easier compared to companies from other industries, from mining, for instance, or maybe from even retail. So real estate is maybe the basic model that you should know, and you should know and understand how it can be calculated. So let's get started. Now what we have, let's assume that we have a company, and we assume that this company is this company has some land plot, and the company is thinking what it could do with this land plot. So there are different variants. Here they are presented as scenario analysis. So the company is considering, in the first case, using this land plot to build commercial real estate. So it's going to use it as offices. And the second variant is going to be using this land plot as to build both offices and apartments. And in this model, we're going to build all those cases so that management and shareholders could compare both variants and understand which is more profitable and which is better off for the company and for the shareholders. Other scenarios include different vision concerning sale of real estate. So there are two variants. The company can either exit after construction, which means that, for instance, the company can sell real estate to the lease holders, or another variant could be sale in 2030, so after a longer period of time. Now let's move further and have a better look at the model and at the model's assumptions. So here are specific things that you should know about real estate. There are specific terms like GLA and GBA. What does it mean? So GBA stands for gross building area, which means that it represents the total area of the building. Of course, it's not 100% used for leasing. That's why there is another term, GLA, gross leasable area, which means the total area that can be leased to leaseholders. So here in our example, it's about 71%, which is usually the case for most companies having commercial real estate. Then what we also have here, so we have different scenario analysis concerning what the company is going to build. So in the first scenario, as we have covered in the beginning, the company is considering building offices mostly. So here we have 4 stages, means here that the company is gonna build different buildings and construct them at different time. That's why it can start using these areas not at the same time, maybe, but maybe at different points of time in the future. Then we assume that there are going to be some parking area for cars. We make assumptions how much it's going to be. We assume GLA, so gross leasable area for those buildings. So here is going to be on average 71%, as we see here above. Then what we also have, we have also GLA for parking area, and we have information concerning number of parking spaces. So then we have another scenario, assuming that instead of the 4th stage, the company is gonna build apartments. Here we have other assumptions concerning this case. So again, parking area, number of parking spaces, and so on. And we have assumptions concerning tax regimes. So value-added tax rate is equal to 20%, corporate tax rate 20%. We assume that the interest rate for credits is going to be equal to 10%, and if we have some cash deposits, then they're going to bring us about 5% per annum, so annually. Then we make assumptions concerning investment phase. So here we have a model based on quarterly basis, and as we see, construction phase is gonna end only by the first quarter of 2023. And after that, the company will be able to use some facilities. Here it assumes, for instance, that for the first case, we will be able to use the first stage buildings, then the second stage buildings at the same time. And then it's going to take some time until we build the buildings from the 3rd stage and from the 4th stage here. So here are simply the flags showing us when we will be able to use this area of those stages, so that we can model everything correctly. And the same concerns apartments. Here it's modeled. So 1 means that we can already use it and lease it. 0 means that it's still under construction. So now let's move further and understand what other factors you should take into account when preparing a model like this. So first of all, you need to make assumptions concerning effective lease rates. So here we have 3 scenarios: optimistic, basic, and conservative. And all those scenarios assume different lease rates. Of course, the best case is optimistic, and the worst case is conservative. Then we have lease rates for parking spaces. We have assumptions concerning occupancy for the first stage, which means that it shows us the percentage of our leasable area that is going to be used and leased to some tenants. So we assume that by the end of the investment phase, we're going to reach about 95% of occupancy rate for the optimistic case, and about 85% for the conservative case. And similar assumptions are made for other stages. Then what we have here as well, so we have similar assumptions also for apartments. It concerns the case and the scenario when the company also builds apartments instead of the 4th stage. Then to understand how much we could earn finally at the end of our investments, we need to make assumptions concerning sale prices of these objects. And again, we have different assumptions from optimistic to conservative. Then we'll move further. Also, we assume different sale prices for apartments, sale prices for parking spaces, and so on. And of course, in a business like this, you need to make some expenses. So those expenses are operational payments, and here we have operational payments that the company receives from lease holders, and after that, this money is going to be used to pay for operational expenses of the company itself. Also, usually leaseholders make payments for utilities, which means that they can pay for electricity, for instance, for water, for gas, or for other kinds of utilities that are available at this building. Here we have again the assumptions concerning this part of our sales. Then we move to operating expenses. Here we assume operating costs per square meter per month. Then we have again assumptions concerning utility costs. Again, it's based on 1 square meter per month. Then we have assumptions concerning real estate tax and assumptions concerning brokerage. So to be able to lease your premises, your area, you need to get someone who will help you to find leaseholders. And maybe the brokerage here is the easiest way how you can do it. That's why we include these expenses in the model as well. And now we move to another part. We consider capital expenditures. That's the assumptions made by the company's management. First of all, we need to buy the land. Then we need some engineering and approvals. Then we need to make capital expenditures for the first stage and then for other stages further. So here we have just gathered all this data concerning capital expenditures. Please have a look. We have most all of our capital expenditures with value-added tax, which means that we'll be able to refund some part of it in the future. Then we have another scenario where we assume that instead of the fourth stage, we can build apartments, and of course the amount of investments is going to be different from what we had in the first scenario. Then we make forecasts using all the data that we had before, so we can calculate our operating income for different stages here. So we have assumptions concerning our revenue. Then we had assumptions concerning our expenses. If you look at those calculations, you can see that the final result comes from the assumptions that we had in the past, from the total leasable area and from the occupancy rate. So it's pretty easy. Then we can do the same for other stages, for apartments as well, and so on. Then we can calculate cash flow from operations. Why real estate financial models are pretty easy? Because they usually don't assume that your cash flow statement is different from your profit and loss account. Those statements are pretty the same, and the result is almost the same. That's why we don't need any balance sheet here. We simply assume that our profit and loss account is almost the same as the cash flow statement. So here we calculate our cash flow, then we calculate our profit tax. This way we have calculated cash flow from operations. Then we had already our data concerning investments. We can calculate cash flow from investments. Also, as you see, we have some value-added tax refunds here from capital expenditures. And now, this way, we have calculated cash flow from investments. This way, we can calculate free cash flow to firm, which is here. And from these figures, we can calculate discounted free cash flow to firm and other things like NPV and IRR of the project itself. And then to calculate free cash flow to equity, we can assume different financing mechanisms. Here we assume that in the beginning we're going to use equity, and then we're going to use debt. And you can have a look at calculations to understand it's a bit better. So, and at the end we have free cash flow to equity. So that's it. Thank you for your attention.